Did you know that the biggest stock market crash in history wasn't just a freak accident? It was a secret game played by a powerful few who knew exactly when the disaster would hit and cashed out while millions lost everything. In the next few minutes, you'll uncover how they pulled it off, what signs everyone else missed, and why this story still matters today. Picture this, it's 1929, the height of the roaring 20s. Headlines scream about endless wealth and booming prosperity. The economy sparkles with a champagne glass brimming over. Everyone, from taxi drivers to shoeshine boys, is convinced the stock market can do no wrong. Stocks are climbing every day, hypnotizing the public into a false sense of invincibility. But beneath this glittering surface, something ominous is brewing. A storm masked by greed and blind optimism waiting to explode. Every warning sign was there, but they were buried under the layers of false hope and escalating speculation. Interest rates were rising, margin calls were spreading, and insiders had begun quietly unloading their stakes. Yet, the masses refused to look up, too dazzled by the soaring portfolios to notice the cracks forming beneath their feet. Now, the year had been building towards October, a month forever etched in financial history. It began with a single tremor, a subtle but deadly shake in the market's foundation. The Dow Jones Industrial Average started slipping quietly in early October, but it was just the calm before the storm. On Thursday, October 24th, 1929, Black Thursday, the crash erupted. Nearly 13 million shares changed hands in the frantic first few minutes of trading, as panic gripped investors like a vice. Prices plummeted 11% almost immediately. The ticker tape machines couldn't keep up, leaving brokerage offices in suspense and confusion. Major banks tried to stem the bleeding by buying massive stock blocks, creating a brief illusion of stability. But the damage was done. The public's confidence was shattered. The mess was deepened by Monday, October 28th, Black Monday. The market plunged again, shedding nearly 13%. Voices at the New York Stock Exchange echoed with panic and desperation. The walls seemed to close in on traders as the roller coaster of losses raced faster. Then came Black Tuesday, October 29th, 1929, the day when history was sealed. Over 16 million shares traded hands in a single market paralysis fueled by widespread panic. Approximately $14 billion in stock value was erased, an unimaginable sum in 1929, and thousands of investors were wiped out overnight. Some stocks had no buyers at any price. The market had become a maelstrom of chaos, where even fortunes could vanish on a whim. The Dow lost nearly 12% more, marking a staggering two-day loss of over 23%. In the weeks and months following, the market staged brief rallies but never regained its footing. By July 1932, the Dow bottomed out at 41.22 points, nearly 90% below its peak from 1929. Almost 25 years later, in November 1954, the Dow will finally close above its pre-crash levels, an economic scar that defined a generation. But what made this collapse so devastating? The story lies not just in the fall, but in the players who saw it coming and their secret moves. Joseph Kennedy, a patriarch of one of America's most famous families, was no fool. By early 1929, Kennedy was quietly selling his stocks, sensing the bubble was bursting. The story that he sold after his shoeshine boy gave him stock tips is a myth. The reality was Kennedy's mastery of leverage and risk. He knew the market was a house of cards built on borrowed money and unchecked speculation. When everyone borrows to buy stocks, the system is fragile, and Kennedy chose to exit before the inevitable collapse. Bernard Baruch, a financial giant and advisor to presidents, sensed the same storm gathering. He recognized patterns from past panics, the frenzied buying, dependence on credit, and reckless optimism, and moved much of his portfolio into cash and government bonds before the crash. Baruch's survival was a lesson in seeing truth beneath the noise. Meanwhile, average Americans, many never before investors, plunged headfirst into the market frenzy. Borrowing on margin became widespread, inflating prices beyond any rational value. Margin calls, the demand from brokers for more collateral when stocks fall, started flooding brokerage houses, pushing investors to sell at losing prices, creating a feedback loop of panic selling. Across the Atlantic, foreign investors, especially British banks, began fleeing the American markets weeks before the crash. They silently liquidated their positions, moving funds back home. When Black Tuesday hit, their capital was safely sheltered while the masses faced ruin. Imagine the frantic trading floors, the clatter of phones, the shout of brokers, and the sweat pouring down faces as millions of shares changed hands in desperate attempts to escape losses. The market was no longer just numbers, it was a violent unraveling, shaking the very foundations of the American economy. The Great Crash marked not only the destruction of wealth, but also the beginning of the Great Depression, a decade-long global economic downturn that changed societies worldwide. The market's collapse exposed the fragility of financial systems reliant on unchecked speculation, leverage, and overconfidence. The lesson echoes today in finance. History rarely repeats, but it often rhymes. Recognizing the signs, understanding systemic risks, and acting with informed caution remains critical. Will you be the one who learns from history or the next to lose everything?